Hello, everybody.
Hello.
Hi, Christine. Hi, Lauren. Lauren is connecting to the video. Get my notes. All right. Well, I guess this is going to be a little bit of a test review, huh?
Yep.
See if you know all your debits and credits, Christine, without even thinking about them.
Well, I can't say
Maybe that's the problem. Nobody's thinking about them. Anyway, I'm sorry. Go ahead.
right. No, I've thought about him for years, and I know a lot more now than I did before.
Realize all the power you had when you were doing the work.
Oh, no doubt. Well, now it's like every time I had to just do a reconciliation, and I'm like, and I had to do a journal entry. I was like, okay, let's see. It's an asset, so it's got to be on the left.
So I'm glad to see it's having some real world effect, huh?
It
Hold on one.
is.
That's great.
It is for sure. My clients will appreciate it.
What kind of a business is it, did you say?
I just have a bookkeeping business. I only have like 5 clients right now, but it's one of my clients has 5 different entities, so he kind of keeps me busy.
Wow.
Yeah, but it's good. So this is something like, now I don't have to do the guessing game. Let's see, it should be on the left or the right, Well, I'll switch it to the other side. But I just do reconciliations and no like real intricate accounting stuff.
When you say reconciliation, you mean like a bank reconciliation?
Yeah, bank and credit cards and yeah. So just, nothing I have to do that's really like pivotal on financials or anything. So.
Yeah, we'll get the bank reconciliations fairly soon.
Yeah, I like those. Those are fun.
Okay. All right. I'm going to bring up a PowerPoint and then, maybe we just chat a little bit and see what we might do here. Share screen. Okay. Move this guy over here. All right. The closing process. I thought we'd go over that. Maybe work backwards with the more complicated stuff. Couple of notes here. On the closing process, we're going to be using that big worksheet, right? Where is it? I'm looking for an example of that. Okay. Oh, for heaven's sake, just bear with me, please. Okay. Here is the end of the worksheet, okay? And let me make this bigger. Now it won't let me zoom. Okay, let's try it this way. All right. The worksheet has 10 columns, right, Christine? And the first 2 columns represent the trial balance, the preliminary trial balance. The next 2 columns are for your adjusting journal entries, right? Then columns 5 and 6 are where you pick up the new trial balance by adding or by debiting or crediting the adjustments to the original trial balance. Columns 7 and 8 are the income statement. Columns 9 and 10 are the balance sheet. The reason I went over it like that, they usually like to put a couple of questions on the test where they say, what is in column 5 of the worksheet? Okay. So just keep that in mind, what the worksheet looks like, and that'll be quite important. Okay. Let's see here. Hold on. Let me move along here. Oh, geez, this thing is giving me trouble. It's a troublesome day. Okay. Are you pretty good with the closing entries, Christine?
Yeah, Yes, but there was, you know what, there was one, God, there was a question on the quiz that, I mean, I had to like Google it to find it because I was just like,
Oh, really?
oh,
What was it?
yeah. I mean, it's probably in here and it's probably like the question number one on the quiz
And what was
was
that?
like, maybe it's just complicated because, well, actually, well, I don't know if I can get back into my quiz, but it just, it's like a, you know, one of those questions where it's the owner's entity in the business amounted to 52,000 at the beginning of the year and 100,000 at the end of the year. And then the owner had made no additional investments and had withdrawn 19,000 during the year. The net come for the year amounted to, I don't know why, but I just like,
Well, that's an easy one.
is it?
Remember about biding your time? Bide.
Bide.
Yeah, you just write on a piece of paper the beginning equity plus the net income, which is what you're looking for,
Right?
minus the drawing is going to equal the ending equity.
Beginning. Um, okay, minus the net income will give you,
No, plus the net income,
oh, plus the net income, and then
minus the
minus the
drawing.
draw, right?
Minus the drawings will give you the ending equity. So what
Right.
they're
Okay.
doing there, Christine, they're simply giving you three or four items.
And then I just could find because obviously when you got three of them, you can get the, okay,
Yeah,
got it.
yeah.
That makes sense.
Okay. Hi, Patty. Patty's with us.
Yep.
All right. And we have someone else heading in here. So on the closing statements, hi, Shannon. Okay, so I'm going to go over the closing process for everybody, okay? This will be a little part of your second test. Permanent accounts are the balance sheet. Assets, liabilities, and equity, you never close them. They're permanent. They're permanent. We don't go out at the end of the month and zero out the cash as much as we might be tempted to, right? The temporary accounts are the items that appear on your income statement. Drawing is the one little exception, okay? So how do we close these accounts? We close them by debiting the revenues because revenues have a credit balance and we debit them to zero them out. Expenses, the opposite. Expenses have a debit balance, so we are going to credit the expenses. Credit the expenses. Another way to say it is we're going to give the income statement accounts, revenues and expenses, a zero balance. And these are the four basic steps. And these are two very good slides I urge you to look at. Divide and conquer, right? Close the revenue first. Close the revenue first. You know that you're going to debit the revenue to zero it out because revenue has a normal credit balance. So you would debit your revenues and credit income summary. Income summary. Step two, do the expenses. You're going to start by debiting your income summary and then list all of your expenses and credit each and every one of them. At that point, you have now put the net income into the income summary, which is just a clearing account. It's just a holding spot. It never has a balance on your financial statements. You have now moved the net income into the income summary. Step three, zero out the income summary, close the income summary. Hopefully there is a credit balance in the income summary, which means you made a profit. So you got that credit balance sitting there. You're going to debit the income summary to clear it out, and you're going to credit the owner's capital, okay? And then step four is the easiest one, drawing. All you do is close it to capital. Drawing has a normal debit balance, so you're going to credit it to get rid of it and then debit the owner's capital. Drawing will reduce the owner's capital. Oh, hi, Krista. How you doing? I see you joined us on the bottom there. You okay? We're just going over the closing process here.
Great.
Let's take a look at it here. That's interesting. Yeah, it won't let me blow it up the way I normally would. But take a look at it here. The owner's capital, assets equals liabilities plus equity, right? So here's your owner's capital. It consists of two things, your net income and your drawing. Let's start with the revenues. I said that you close the revenues with a debit. We see that nice debit there? We debit the revenues. Revenues are now zero. And we take those revenues and we put them into the income summary. How about that? We do the same logic with the expenses, except we're crediting the expenses to zero them out. And the expenses also go up to income summary. So at that point, you have your revenues and your expenses, or another way to say it, you have your net income in that account. So it's just a matter now of debiting or crediting this account. Hopefully we're going to debit it to close it out. They're optimistic. They're debiting it. And we credit owner's capital for the amount of the net income. And then step 4, get rid of the drawing. It has a credit balance, it has a normal debit balance. You credit it to zero it out. And that has the impact of reducing your owner's equity with the debit up there. Anybody have any questions on the closing? Anything they find confusing or? Okay, looks like we have a group that's in tune here. Hold on. And let's look at it in this form over here. Here's the same thing, only now we have numbers. And let's take a look at it. The balance in your revenue accounts, delivery fees, was $8,000 credit. We now debit it and we move that 8,000 up into the income summary. We take each and every expense, every one of them has to be credited. You credit wage expense, rent expense, etc. You bring that all the way up to your income summary. And now you have your net profit sitting there, a balance of 4640. You close it out with the 4640 debit, number 3, to capital. And then the drawing, you get rid of it with a credit, and that has the impact of debiting your capital or reducing it, Look at your journal entry. Step 1, these are your 4 steps. Step 1, close the revenues, debit your revenues. You might have more than one revenue account. Big companies could have a whole bunch of them, but you list each one and then you credit income summary. So you closed out the delivery fees. We got to get rid of all these expenses. Well, this time we're going to end up debiting income summary, and you credit each and every single expense. So $8,000 minus our total expenses equals the net income of $4,640, which now resides in the income summary. You debit income summary to clear it out, and you credit capital, and you remove the drawing. Okay. After we've closed, we have to prepare what's called a post-closing trial balance. This trial balance is prepared after you close, do the closing entries, and all it does is tell us that debits equal credits. That's all it does for us, okay? But the important thing to understand, the post-closing trial balance will not include any of the temporary accounts. The post-closing trial balance is post-permanent accounts. The only thing you'll see on the post-closing trial balance are assets, liabilities, and equity. So take a peek at it. Look at that post-closing trial balance. This one split second of time, you have no revenues and no expenses. Now, if you ran this report, if you went in at the end of the first hour of your business and you ran this report, you will see the revenues hopefully coming through and the expenses, okay? Post-closing trial balance, no income statement items on them at all. At all. And this is kind of a wordy looking slide, but I think we're in a point now where we can divide. I use that expression a lot, divide and conquer. On the test, they like to ask questions off this thing, okay? What's the accounting process? You start by source documents. You analyze things. Source document like a cash register tape or a check or a bill from a vendor, or you send your own bill out to somebody, a deposit slip, and it can also be the printout of an email or a text. So you have these hard copied items available to you to do your analysis. And once you've done that, you're ready to write your journal entries. Your book calls them general journals. We post those to the general ledger account. You write the journal entries. At the end of the batch, you look at them one more time, you double check them, and then you bless them by hitting the button called post. At that point, the general ledger is updated. Now the month end comes. You've been doing steps 1, 2, and 3 every day during the month. Now we're at the 31st of the month, and we're ready for step 4. Prepare a trial balance. Let's prepare a trial balance. That's our starting point. And then we know we're going to adjust the trial balance or adjusting entries. You remember the good old depreciation expense and the wage accrual and the prepaids. Those are your adjusting entries. The next 2 columns would be the completed or final trial balance. And then you're going to do the income statement and the owner's equity statement and the balance sheet. And you journalize and post the closing entries and prepare the post-closing trial balance. So I would, in your study, and just look at this a little bit and kind of get that flow in your mind. And it might do you some good on the test. So I'm going to go back here now. I'm going to move down here. Remember the sequence of the financial statements. I guarantee they'll ask something like that. I know they'll ask something like that. I remember when I was first out in the workforce, my boss said that he was working on the income statement, and I wanted to be helpful. I said, okay, while you're doing the income statement, I'll finish the balance sheet. That can't be done. That can't be done. You must do the income statement first. At that point, he knew he had an idiot in the office, but no, not really. The income statement preparation, baby. Owner's equity statement. Earlier today, Christine had a good question that gave her some trouble on the practice quiz. The question was, they gave her the beginning equity balance and they gave her the ending equity balance and they gave her the drawing. And the question was, what was the net income? What was the net income? Well, the way to attack that problem is to have this template in your mind and able to scribble on a piece of paper if you need to. Beginning equity plus income minus drawings equals ending equity. Bide your time. You got to bide your time. BIDE. Beginning income drawings ending. And simply, they gave you 3 of the 4 elements, and all you do is a little bit of mathematics just to come up with the missing factor, okay? Oops, let me fix this. Let's talk briefly about current assets. Current assets are those that are going to be used up within a year, within a fiscal year. They're the most liquid of your assets. They're the liquid ones. Liquidity means the ease of turning an asset into cash. Cash is already liquid. It is liquid. Accounts receivable. You might have $1 million of accounts receivable that your customers owe you, but you might be desperate for cash. You can take that $1 million of accounts receivable to a bank and say to the bank, these are good receivables. My customers pay. How much will you give them to me for them right now? And they might say, I'll give you 800,000 right now. And then everything that you collect after that goes right to the bank. Supplies, prepaid. Current assets. Long-term assets. Plant assets, fixed assets, they're called. Your land, buildings, and equipment, that type of thing. The assets, they're going to last a long time. We're going to use this building to make our product, and we're going to use this equipment to do it. And we're going to do it for years and years. Fixed assets. Current liabilities. Again, these are liabilities that we are going to pay within 1 year. Okay? Within 1 year. Current liabilities. Long term, the longer ones. Okay? So that's a quick look at chapter 6. So I'm kind of working my way backward here, if that's okay. That's my style. All right. So let me get into chapter 5 here. Just take a second. Chapter 5. Chapter 5. Come on. Chapter 5. It's zipping the modern way. All right. Let me share it. You can see it, right?
Yep.
Okay, I just need that affirmation. Because a couple of times I've been caught not realizing these students are looking at a blank screen and I'm going on and I'm pointing at stuff that's not there. Don't want to make that mistake again. Okay, adjusting entries. I bet this was kind of the harder part of the class so far, huh? Adjusting journal entries. You are going to make these entries at the end of the month. And the reason you do it is because of the principle called the matching principle of GAAP, where you match revenues and expenses. You record expenses and revenues when they occur. You've heard me talk about this like crazy. It has nothing to do necessarily with the cash movement, okay? You made a sale in the month of June for $1 million. Well, June's financial statement will show you that $1 million sitting there. You're not going to get paid for 2 more months. That's okay. The sale was made this month, and it would go into accounts receivable. That's all, instead of cash. The matching principle. What are we matching? Revenues and expenses. A fiscal year, we know it can be anything. Fiscal years, I think I talked a little bit about this. I'll do so very, very briefly. Companies actually pick a fiscal year strategically sometimes. Nordstrom's and those high-level stores, their fiscal year end is around the end of February. And the reason is they want to get their financial statements put out pretty quickly after the December closing, and they want to capture everything they can at year end. General Mills is an old farm company. They make cereal. They go from the planting to harvesting year. Okay, adjustment for supplies. Let's go over the adjusting entries one more time. Supplies, that's an asset. Mitchell bought supplies. He bought $80 worth of supplies. And those $80 are not going to be used for a while. So at the beginning of the month, say he bought $80. And then at the end of the month, there were only $20 worth of supplies out there. How do you know that? Because somebody physically went out and counted the number of supplies. Okay. That means we use 60. So this asset here has been consumed to the point of $60. That $60 becomes supplies expense. Supplies expense. You're going to debit supplies expense, credit the prepaid supplies. And there it is right there. We debit supplies expense, we credit the supplies, prepaid supplies. Remember, at this point in the course, all of your adjusting journal entries require a debit to an expense, okay? And here's another tip. Students make this mistake all the time, and God knows why. You never, ever have cash in an adjusting entry. Sometimes students get a little confused and geez, I don't really remember this. And they say, I'm going to guess cash. Well, don't guess cash, okay? Here we go. Prepaid insurance. Now, this is the same exact thing. Prepaid insurance. You have an 8-month policy and you paid $700. That 200 should be 700. And I keep forgetting to tell Cornelia, these are her slides to fix that. So you paid $700 for a policy, and it's for 10 months or $70 a month. So every month you're going to reduce this asset because each month you've gotten the benefit of the insurance. So your journal entry is going to be a debit to insurance expense, credit to prepaid insurance. And we could take a look at it over here. You debit the insurance expense and you credit prepaid. So the balance in the prepaid insurance account after the first month of the policy is $630. Next month, you're going to do the same exact $70 entry, and the balance is going to go down to $560 to $490, $420, $350. You get the idea, until you end up at zero. And that asset has been totally consumed, and hopefully you didn't need it. The building didn't burn down or anything, huh? Here's the one that you might understand pretty intuitively. You worked the last 3 days of the month and earned $400. But you're not going to get paid for maybe a week or two, depending on your company's policy. You might not get paid for a month. I get paid once a month. But I'm earning that money now. So you earned the $400 on June 28, 29, and 30, it looks like. That is an expense that needs to be accrued. This is called an accrual entry. We are going to say to ourselves, we have $400 of additional expense we must record, okay? So how do we do it? We're going to debit wages expense. Remember, all your debits with the adjusting entries are expenses. And we're going to recognize that we owe the money right now. We owe that money, $400. If an employee, and I probably repeating myself a little bit, but that's okay. If an employee at the end of the month said, I quit, you have to pay him that $400 then. You can't say, okay, come back on payday. You know, the employee might be agreeable to that, but if the person says, no, I want my money now, I'm going out of town and I need my check in hand, you have to pay it. If you fire the employee, same thing, or the business ended. So let's take a little bit of more of a look at this. We debit wages expense. That brings the balance up to 2050. The balance that was sitting there earlier, the 1650, that represented the payroll from July 1st to the 27th of the month. That's the payroll that they've already processed. They've already recorded it. There's nothing to accrue. They've already recorded it, and they probably already paid it to the employees. The $400 just increases that balance. All right. And then the last adjusting entry is, I always call this the easy one, but students make mistakes. They still, it's all new to everybody. Depreciation expense. Okay. Remember, that fixed asset is going to stay at the same cost for which you bought it, called the historical principal. The historical principal. I'm going to refer to I have a few notes here. I want to make sure I cover everything. An asset is given a useful life. When you buy an asset and you intend to depreciate it, you must give it a useful life. It's supposed to be how long you think the machine will actually be beneficial to you. There's very little wiggle room. If you buy a car for your sales manager, and he's going to be driving this thing up and down the West Coast, he's going to put a ton of miles on that car. Maybe that's a car that you're only going to depreciate for 4 years. If it's a big machine that is going to last for 20 years, well, then 20 years you use. There's very little play there. You can't front load the depreciation expense as much as you might want to, except for one method. So useful life, know that term. Depreciation, what is it? It's an attempt to match, again, we're matching revenues and expenses. We're taking that expense and making sure we record it in the same month where we did the selling. Okay? And your book, you're going to be doing on the test, if there's any of these problems, straight line depreciation. Straight line, which means you're going to take the cost of the machine. If it was $1 million and it was supposed to last 20 years, that would be $500,000 a year depreciation. Know the terms scrap value and residual value. That's just your estimate of how much somebody might give us for the machine when we're done using it. This is a big machine that stamps out cans of soda. Well, typical housekeeper doesn't need that kind of machine. You're not going to sell that at the end of 20 years. But a scrap guy, a junk dealer, could probably come in and take that off your hands, or a machine shop who can make some use of it. Salvage value. You never depreciate the salvage value, but I don't think that's part of the test, but I need to remind you. Straight line. Mitchell bought motor scooters with an estimated 5-year life, and they cost $4,800. And he has to spread that over 5 months. Another way to say that is 5 times 12 is 60, 5 years, I meant to say. 5 years times 12 months is 60 months. 4,800 divided by 60 is $80 a month. You see the calculation? Original cost minus salvage value is the depreciable cost. There was no salvage value here, so we don't have to worry about it. He paid $4,800 for a machine that's going to last him 60 months. So every month, you're going to have the same entry. You are going to debit depreciation expense, and you're going to credit accumulated depreciation. And let me talk a little bit about accumulated depreciation. Accumulated depreciation is what's called a contra account. A contra account. In this case, it means it's an asset that has a normal credit balance. So it's an outlier. All contra accounts are married to, I don't want to say to a superior husband, that would be a terrible way to say it, but they're married to a partner. And in the case of accumulated depreciation, it's married to the original cost of the machine. So the original cost of that machine is going to stay 4,800. That's never going to change. What's going to change, though, is the net book value, meaning the original cost minus the accumulated depreciation. Here we go. Book value, net book value. That asset cost $4,800. And after the first year, we depreciated $80, which brings the net book value down to $4,720. And we're going to make that $80 entry 60 times over the next 5 years. Depreciation expense. And here they're just showing you the postings of the adjusting entries. There is our journal entry. And here we are. Take a look at your supplies. The expense was 60. We had 80 to begin with. And we know we consumed $60, which brings our balance on the general ledger down to $20. And our supplies expense is now recorded at 60. Same thing with the insurance. It was $70 a month. The prepaid policy was $700. We credited the prepaid insurance by 70, knocks it down to 630, debit insurance expense. That entry is going to be made every year, or every month rather, for 7 months until we get rid of that $700 that's sitting there. Here's the wages payable. Well, you worked those 400, you earned $400. So look at your journal entry. You're going to debit 400 insurance expense, and you're going to credit that liability. And that is a legitimate liability in every way. Wages expense have now gone from 1650 to 2050. Depreciation expense. As soon as you see a depreciation expense adjusting journal entry, you know it's a debit to depreciation expense and a credit to the accumulated depreciation, because you never credit the original cost of the asset. Never. Not until you get into chapter 10 and 230, where there's some exceptions, okay? So we're not quite there. Oh yeah, the worksheet. This is what I wanted to talk about. The worksheet. It's a 10-column worksheet. 10 columns. And how do we do the worksheet? We start with a trial balance, and then the next 2 columns are the adjustments. Next 2 columns are the adjusted trial balance, and the next 2 columns are the income statement, and finally the balance sheet. Think of it as a 10-column report. And the reason I'm kind of emphasizing this, I've noticed over the years on the test, for some reason, they'll give you a question like this. They'll say, columns 3 and 4 are what? They'll say, what is on columns 3 and 4? Well, that can be kind of darn confusing. Just try to remember that this is a 10 column page. You have 2, 4, 6, 8, 10 columns, debits and credits. The first columns 1 and 2, trial balance. Columns 3 and 4, the adjustment. Columns 5 and 6, the adjusted trial balance. 7 and 8, the income statement. 9 and 10. You'll save yourself a little bit of grief if you just have that clearly in your head, what the columns are on the worksheet. I don't know why they ask questions like that, but they usually do. Worksheet. Yikes, what happened there? Let's look at this part of the worksheet, huh? This is the guts of it. We started with a trial balance. Remember, we did all those transactions. We did the same transactions in three, I mean, I only wanted three fingers here. In three chapters, we did the same transactions over and over. And we came up with this trial balance. Then we came up with the adjusting entries. So let's take a peek. Look at your prepaid supplies, 80. You credited for 60. That leaves you with a balance of 20. Your prepaid insurance, you credited for 70, balance 630. Accumulated depreciation, looks like they had none because he just bought the item. So you had an entry where you credit this contra asset, 80, which means you bring over that credit balance here. And the wages payable were 400, and that you bring that over here. Wages expense 400, expense. You add them to whatever over here, bring them over. This is the hard part. The adjusting journal entry is the hard part. If you've done that, you're ready to do financial statements because you are now going to be able to produce an adjusted final trial balance, okay? An adjusted final trial balance. And we know that everything after drawing is your income statement. So right away, there's your income statement, 8,000 minus these expenses, okay? Everything above is balance sheet. I don't know why this thing is showing up so fat, everything. And let's finish the worksheet. Let's finish the worksheet. Well, we have to do the income statement first. So you might as well do that first here. Columns 7 and 8 are the income statement. Here's your income statement right here, 8,000 in revenues, and your expenses added up to 3,360. So these two columns are not in balance, but that's good, as long as the credits are higher than the debits here. So we made a profit of 4,640. 8,000 minus 3,360 gives us a profit of 4,640. And now we're going to add that to the beginning balance on the debit side, just to have this come out even, 8,000, 8,000. If we've done the worksheet correctly, when we bring over all the balances from the adjusted trial balance, we should be off on the credit side by the same amount, the profit, and we are. And we simply say, we take the lower number, we add the net income, 12,020, and now we're ready to go. We've done our balance sheet and we've done our income statement. It's just a matter of taking this income statement here and actually doing the statement where it says Mitchell Consulting, income statement for the month ended July 31st, 2021, revenues, and then you list them and prepare a nice looking income statement. Not going to go over methods for finding errors here, okay? Let me see if there's anything I want to talk about there. Yeah, I think I pretty much got through that part. Okay, let's go back to another chapter here, okay? All right, I got to go to the module. Excuse me, Krista, did you get any help on the question you asked earlier?
Not yet. I'm still working on it.
Cornelia didn't get back to you, huh?
No, she did not.
Okay. Maybe one of the other students succeeded doing that. We can ask. Let's see here. All right, hold on. Do that. All right. Oop, wrong chapter. We don't want chapter 6. We did chapter 6. Chapter 4. Chapter 4, okay. Okay. Give me
Did
the
I
frame
miss
nod
the
that-
review for 1, 2, and 3? Or are you just going backwards?
I'm kind of going backwards.
Okay.
I'm sorry about that. I should have done 1, 2, 3 first. But that's my style when we come to the test review. Journalizing and posting transactions. Posting transactions. Posting source documents. We know what source documents are. The chart of accounts. Yeah, understand the chart of accounts. The chart of accounts. It's listed in numerical order, right? It's not listed in any other order than assets, liabilities, equity, revenues, and expenses. Okay. Chart of accounts. And there's an example of your chart of accounts to get you started. Cash, accounts receivable, supplies, prepaid insurance. If a company wanted to, they might say, well, I don't want a separate account for supplies, and I don't even want a separate account for prepaid insurance. Let's put them into one account called prepaid expenses. You could do that. It's just up to each company how detailed they want their chart to be. Journal entries. Okay. I'm not sure we're going to go through this chapter too much, but get a look at your journal entry again. Journal entries. They must have a date, the name of the two accounts. And remember, you have to have at least one debit and one credit. One debit, one credit. Indent the credits. Very, very important. And you debit here and you credit here. And there really should be an explanation, like it says here, owner's original investment in delivery business. So I think we know how to write the journal entries, but let's just look at a few here. Any questions on this? Do you feel the need, really need to dig into this chapter? Because we're just looking at how to write a journal entry, writing a journal entry. Look at the posting. Look at the posting of your journal entries. We wrote journal entries in chapter 3, I guess it was, or not chapter 3. We did transactions in chapter 3. Here is your cash T account. And here's how it looks in the general ledger. You had nothing to begin with. So this fella, he invested $5,000 in his business. So he debited cash and he credited equity, but we're only looking at the cash right now. So his balance was 5,000. He then spent 2,000. He spent $2,000, and that brought his balance down to 3. The next activity he had was 600, where he spent more money, etc. So this is what your T account looks like. And look at your general ledger. The general ledger is a glorified pair of T accounts. This is the formal record of the company. This is the formal books of the company, if you will. The auditors will come in and they'll look at that ending balance maybe, and they'll say how much money you have. And this is a big company. You say, I have 470 million in the bank. Well, they'll say, show it to me. And maybe you show them your bank statement. You show them the entries. Then the auditors are going to look at your bank reconciliation, which is super important. And then maybe even more important than that, they're going to contact some of these people. This guy with the 3,000, they'll probably pick some of the big ones and a couple of small ones, and they'll have the banks verify that. They'll come back the next month before they finish their audit and make sure there were no shenanigans in the first few days the next month, okay? So I think we should be good here. The trial balance is printed out at the end of the month, and it comes off the general ledger. It's just the balances from the general ledger. And all it does is prove that debits equal credits. It's not a report. I'm not going to go over how to find errors. Just that one divisible by 9. I still find that useful. You flip a number. If you wrote down 648 and you meant to write 468, the difference is going to be divisible by 9. And that can help you, not in QuickBooks, because you'll never be able to put in a number that goes out of balance, but it'll help you in Excel. Suppose you're sitting down doing a report and you have to take these two columns and you key in the first column and you key in the next column, and they're supposed to equal for whatever kind of report you may be doing. If they don't equal and the difference is divisible by 9, that will really help you a lot finding the culprit, because it's pretty quick to see where number got flipped. If the tips don't work, you're screwed. You might have to go back and start all over again, retrace, double check, correcting entries, okay? Now, that was kind of, Krista raised a good question. I just did the review for the second test, okay? Maybe we should have started with chapter 1, but let's do that. Now, reviewing the other 3 chapters should not take nearly this much time, I wouldn't think, but let's go through it. Let's get our ducks in a row here. So I'll start with chapter 1. Let's go back to the beginning. Chapter 1 says you love. Chapter 1, come on. All right. Chapter 1, share. Okay, now this is just our introduction, but they put a surprisingly pretty good amount of questions from chapter 1. So let's go over what we really need to look at. And let me refer to my notes again. I have a separate set of notes for these 3 chapters. Okay. The purpose of accounting, providing financial information to third parties, right? Financial information. People need financial information. Investors, lenders, managers of the company ownership. Banks need it. Who uses this information? Owners of the company, managers, creditors. No one's going to loan anybody money without audited financial statements done on an accrual basis. Managers, I find, when I say manager, I mean like a sales manager, a controller, which is what I was for most of my working world. Those are the guys that are really interested in how the company's doing, because bonuses might be based on that. If you're a sales manager and you get a bonus of 10% of all profits above a certain number, believe me, you want to see these financial statements, okay? The IRS really wants to see them. Make sure you're paying all your taxes. The accounting process. Now, they go through these various steps. And on the test, they like to pick a step or 2 out and ask you what it's all about. So let's take a peek here. Accounting is a system of gathering and reporting information. And they go into this 6-line thing here: analyzing, recording, classifying, summarizing, reporting. Let's understand what they mean first. Analyzing, that's looking at your source documents and figure out what you got to do, what you must do. Recording, that's the journal entry. You're entering it into your system and posting it. And when you do that, you're classifying things into the right pocket. You're putting your expenses into the correct chart of account number. You're classifying correctly. You're putting assets with assets, etc. And then you summarize at month end. That's what we just kind of looked at in chapter 4 just now. We're looking at the general ledger at month end, and we make sure that we've summarized everything. And then we come up with some reports. We come up with reports that are usable and readable for the public, for the non-financial person. The reporting, that's your income statement, your equity statement, your balance sheet, and then you interpret it. I mean, I worked for a very big company, but my division was tiny, and I just loved it all those years. I worked at a tiny division in Los Angeles, but I had to do some of the same reports that the bigger companies did. And what I'm getting at, I had to quote interpret what happened the month before. And it really became a boring, repetitive job because we were a profitable little business. But every month I would have to say something like, raw material costs were 10% higher than last month due to a price increase caused by our major vendor. That's that type of thing. We did not hit our target profit-wise because gap and FASB, gap. Generally accepted accounting principles. Generally accepted accounting principles. What are they? Those are the rules of how things are to be recorded into your financial statements. GAAP means accrued financial statements on an accrual basis, not a cash basis. We're not teaching anything with a cash basis. The only thing a cash basis is good for is putting you out of business because you're never going to know quite what you're doing. GAAP, generally accepted accounting principles. Who promulgates these principles? Well, it's the American Institute of Certified Public Accountants under their FASB, their Financial Accounting Standards Board. And what that board does, it's always looking at accounting, and companies might be saying, you know, this one principle doesn't make sense in the modern world. Perhaps we should consider doing something differently. And I'll give you a couple examples of things that changed just in my career. It used to be that Nordstrom's, when they got a payment for a gift certificate, they forgot about it. You go, you know, your aunt gave you a $100 gift certificate to Nordstrom's, and you never used the gift certificate. You put it in your pocket or wallet or purse, and kind of forgot about it for a year or so. Well, the store was under no obligation to do any accounting. If you didn't use it, that was fine. They really wanted you to use it though, because typically when somebody uses a gift certificate, you end up spending more. So anyway, they changed the rules that businesses now have to predict, if you will, how much of their cards are going to be used and record an appropriate amount of income. Goodwill, which you'll learn about in 230, goodwill used to be amortized. That's no longer the case. The sale of a fixed asset used to be considered an investing cash flow. That's now operating. So that's the type of things they do. Know your three different types of businesses: your sole proprietors, your partnerships, and your corporations. Know that sole proprietors and partnerships and corporations, they are for-profit type places, right? They're for profit. Nonprofits would be your schools and your churches and your hospitals, places like that. Sole proprietorship. Just remember, any money you personally invested in a sole proprietorship or a partnership is subject to being taken away from you, plus your personal assets that you never brought near the business. You start a business for $10,000 and suddenly the business owes $100,000 and you're out of business. You can't say, well, wait a minute, you can't take my other 90. I never put that into the business. Yeah, you never put that money into your business, but because it's a sole proprietorship or partnership, you are personally responsible for these debts, okay? Sole proprietorship, owner takes all the risk. Owner takes all the risk. Sole proprietorships are the most common type of business in the United States. The salt of the earth, you know, small businesses, you know, make the country hum. Partnerships, two or more. Partners share risks. And the problem with partnerships is partners disagree and they end up, like I said, on crime shows shooting each other, okay? Partners may disagree on how to run the business. If one partner says, I'm out of here, that means the business has expired. There's no longer a business. So one guy can just cut the business right off if he's not bought out by the other partner. And you might find this interesting. Partnerships typically exist in intellectual property type companies. For example, architects, CPAs, lawyers are typically partnerships. And I think one of the reasons for that is they're saying to the world, we are such good, honest, capable people. We're not worried at all about sharing the risk of our personal items. We, stand behind our work as professionals. So partnerships are for intellectual property type places. Corporation goes out of business. That's it. If you bought one share of Coca-Cola stock for $50 and the company went out of business, that's all you're going to lose is $50. They're not going to knock on your door and, ask for the keys to your car. Know your businesses by activities, right? A service business, a merchandising business, a manufacturing business. Service business, a delivery company, guy who delivers pizzas, an architect, a CPA, those types of places. Merchandising is buying and selling something. That's a department store, pharmacies, grocery stores. Merchandise means selling inventory. And then manufacturers. This is accounting 230, 240. Service business, that's pretty much us most of this chapter. Service business accounting 110, 230, 240. You manufacture a product. And I don't think we need to look at the career opportunities. And certainly you don't have to worry about the numbers or these so-called salaries. But just have a general idea what these people do. That's all you need, very general. An accounting clerk, this is the person who might file something. They file reports. Maybe they enter into the system. Someone hands them papers, enter this into the system, that type of thing. Bookkeepers, higher level, para account. I've never seen para accountants. And then let's take a peek at this here. Know the difference between public, private, and governmental. These are three big areas of the world's business, huh? Public accounting. Those are your CPAs. They do audit work. They do consulting work now like crazy. They'll do your taxes for you. Those are the people who come in from the outside. They work not for the company, they work for their public accounting company. Private would be, any business like Coca-Cola, 7-Eleven, those, private accounting. And then there's a lot of government work that needs to be done. So you have government accounting, which has a lot of different rules. When you're talking government accounting, GAAP in some areas goes kind of out the window, bunch of exceptions. And then I'm going to say this is important, nonprofit accounting. And the reason I say that is Santa Barbara has so many nonprofit organizations in town. They're one of the bigger employers, I think. I mean, I worked for the Santa Barbara neighborhood clinics for a while. That's a classic nonprofit. Your nonprofits are your churches, your schools. Public accounting, what do? Taxes, management services, forensic accounting, huh? They look for people who have been stealing from you. You can become a CPA or a CFE, Certified Fraud Examiner. Private, we just talked about. Governmental. And then the rest of these are just descriptions, okay? But by the way, I haven't asked for any questions. If anybody wants to cut in with a question or something they don't understand.
I just have a quick question about
Sure, go for it.
exam. I just want to know if it's going to be like kind of the same format as the quizzes have been. Or...
Yeah,
okay.
It is the same format pretty much. It'll be, I think it's 40 or 50 True and false and multiple choice questions.
Okay.
Now, I will give you one little hint, and I'm glad you asked the question, Patty. On the test, you'll be going through the test, and it'll say true or false, and okay, that one's true, multiple choice true. And then all of a sudden, you're going to come to a problem where they're going to ask you to do an income statement. Maybe. They might ask you to do an income statement. They might ask you to write a couple of journal entries. And the first thing you're going to say to yourself is, wow, that's going to take at least 10, 15 minutes. And you'll notice that the credit for it is the same as like a true false question.
Yeah.
So my advice on those, save those for the end of the class. Don't kill yourself on that. Now, I am not grading the test this semester, at least not so far. Typically Cornelia gets buried and then she says, you take over everything. So if I was grading the test and I saw not kids, but I see students answer those questions, I give extra credit for it. I give you an extra 2-3 points. So make it a little more worthwhile. Let's go to chapter 2.
Sorry, for those questions though, when we're doing that, can we just like do it out on paper and then like clip it to the, like, you can upload it as like a picture or a file to those little post boxes?
Yeah, I guess if you did it in your own handwriting, yeah.
Okay.
Yeah.
And then how would that work with the time? What if the time expires and then you upload the document?
You probably can upload it when time expires.
So just make sure it's
Yeah,
uploaded before.
if I was to
Yeah.
do it, I would just make sure I had the time for it.
Yeah. I don't want to make everybody overly confident, but this is not a real tough test. I don't think. I think you'll all do pretty well on this. But that's the one thing that drives students nuts, especially in accounting 230, where all of a sudden, a problem pops up that if you know what you're doing, it's going to take you at least 10 minutes. And like you say, you're strapped for time. You're looking up at the clock all the time. I think it's much more stressful in the classroom too when you're running into it. So as you're taking the test, yeah, you want to monitor your time. You don't want to fall too far behind. And my suggestion to do those more complicated ones late, that's just a suggestion. Maybe you're the type who said, I'll get rid of them first and then go through the rest of the test. Let's see here. Let me lower this. Let me go into the last couple of chapters here.
And how much time will we have to take the test?
90 minutes,
Yeah, it's in the syllabus. Is it 90?
90.
90 for
Yeah.
each part.
Yeah.
Yeah, so you'd have 2 90-minute tests, which should
Okay.
be plenty of time. It comes out to almost, I think it comes out like 2.5 minutes per question.
Okay.
And most of them are true, false, where you either know it or you don't, multiple choice. By the way, have any of you had any success looking at a test you took earlier to review it again and see the correct answers? Have you tried to do that, Christine?
Well, I've actually printed mine.
Before you submitted it?
No, I actually submitted it. Not the homework ones, but the quizzes. I submitted it, and so when I got some wrong, because I printed it and then I just highlight all the ones I did right, and then so I didn't have to do the work like twice.
Well, see, what happened to me was I submitted it and then I get a couple wrong and I go
Right.
back to fix them and the entire test is blank.
No, that doesn't
And
sound.
I can't see my previous
Oh.
answers. And so now I'm starting to study and I want to print out those old quizzes that I've taken to study off of them. And I have the option to retake the quiz, but I don't have the option to print the quiz that I've already taken with the answers.
I did it like once. Yeah, so you can't even see like
I
what you
can't
did?
see it. I have the option to retake it, but I can't see the answers,
Oh.
which
That's
is
weird.
very annoying. So I'm like
I
retaking
don't
these
think you can
quizzes.
print it this way, but if you go to grades and then
Mhm.
click on it there, like you scroll down to the quiz section or however it's split up on yours.
Right.
When I open that, I can see
Or if I can do
the
that.
quiz that I got with all the right answers or whatever, and I can retake it from there.
Now, and the way you do that is you go to the top of the column, right?
Depends on, I mean,
You go in and you click on your grade, right?
yeah, just,
And what happens when you click on the grade?
you then get like your list of, when I look at it, I have like the discussions are at the top of the list, and you scroll down summaries, then homework, then quizzes at the bottom.
Yeah.
And then I can just like click on and say like chapter 2 quiz. And then once I do that, I can just see all the questions and stuff filled in.
Have you been going through those kinds of steps, Chris, that sound like what you were doing?
Well, there's a couple different ways to access it. So I'm clicking on grades. And then I can click on a quiz.
And then you go into I just found it. Go into where it says submission and rubric. And then it's
Okay,
got your attempts on there, and you just click on one.
Yeah, can we try that, right? Could you coach us through
Okay,
that, Christine?
I'm clicking on my quiz.
Right? And then go to where it says rubrics. Wait, let's see.
Rubric.
Rubric. I know.
Okay, here it is.
Okay,
Let me try to print
submission
this
and
out.
rubric. And then like it has, like on mine, it has my 2, in this case, 3 attempts that I did. And so you can just click on probably the last one. And then it
Okay.
gives me all the whole thing.
Okay, I got it. Thank you.
Problem solved, huh, Krista?
That'll help.
Yay.
Thank you, everybody. I really appreciate that, because I knew you could do it. I just didn't know how to do it. Okay, we're getting toward the end here. Slideshow. Chapter 2. Here is where we talked about what a business entity is, any group of 1 or more people who start a business entity concept. We introduce you to what are assets. What are assets? Anything good to have, huh? Anything good to own that the company will use for future benefit. Accounts receivable. And I'm going to remind you all again, you're going to get transactions on the test where it says a sale was made on account. And then your 4 choices will be 4 different journal entries. And you have to pick the right journal entry. If it's on account, remember, it means there's no cash involved. It was on account and nobody had money. So that's either going to be accounts receivable or accounts payable. So if you at least have that in your mind, on account tells me there's no cash involved in the transaction until later when they pay it off in the future. But for now, it's either going to be accounts receivable or accounts payable. Liabilities, it's a debt, an IOU, debts of the company. Accounts payable, be careful. Don't confuse accounts receivable and accounts payable. Are we going to get money or are we going to end up paying? Note payable, they might ask the difference between accounts payable and note payable. Note payable is a borrowing instrument. Note payable means that there is actually a physical contract called a note. And that note said, I agree that I borrowed money from Patty in the amount of $1,000, which I will repay in 3 years and pay him interest of 3% a year until then. And we both sign it. Accounts payable, it's on faith. There's no written agreement. You just agreed to give this company credit and you're counting on them to pay. Now, if the company goes out of business, Patty, who holds a note, would get paid before you guys who don't have a note. That's all. Owner's equity, it's also called capital, net worth of the business. Assets. Our accounting equation. Please don't get confused by this, huh? The accounting equation. Assets equals liabilities plus owner's equity. All right. Assets equals liability plus owner's equity. Another way to say it is assets minus liabilities equals owner's equity. Company has $10,000 in assets. They have 3,000 liabilities. The company on paper is worth $7,000. Okay. And then here we went into transactions.
Is it just my screen that's still on job descriptions?
Pardon me?
No, that's right. It's still on job descriptions.
Oh,
the
I
screen.
made that mistake I didn't want to make. Thank you.
Thank you.
Ugh. You see it now, chapter 2, right? Okay, thank you.
Yep.
Sorry about that. I had one class where I went the entire time, and they weren't looking at what I was talking about. And thank God I happened to glance at the recording, and all I saw was my face and the people sitting there. And I'm gesturing and I'm pointing at the screen, and that might not have been my smartest class. I don't know. Okay, real quick. You heard me babbling though. Assets, anything that's good to have. We know what an asset is. Receivable. Accounts, on account. It's going to be either receivables or accounts payable. Note payable, we talked about the difference. Here's our accounting equation. And then we went into business transactions, but the way we did them was with this world of plus minusing. Remember, this was before we introduced debits and credits. So they set us up with a fancy, remember they kept elongating the accounting equation. So I am going to get out of this chapter in a second and then go to chapter 3, which is the guts of the first 3 chapters. I just want to see if there's anything else here that I wanted to address. Your financial statements, income statement, my goodness, we should know these now, huh? Input, processing, output, huh? Input, processing, output. The 3 basic phases: input, processing, output. They usually like to ask that type of question. Okay, here we go. All right, chapter 3. Here's the one where we got into debits and credits. Chapter 3 goes there. Come on. There it is. Okay. Let me share. I failed to share the last time. New share. Give me the thumbs up if you see it. All right, we got a couple of thumbs up. Okay. Now here's where we started to lay the groundwork of speaking in accounting language. Accounting is the language of the business. Here are some of the vocabulary, okay? A T account is shaped like a T. Debits on the left, credits on the right. That's all it means, right? Debits on the left, credits on the right. Debits on the left, credits on the right. And you have a title. So you should know now that each one of those T accounts is your general ledger. It mimics the general ledger. So there's your general ledger for cash. We're going to put all the activity in there and get the balances. Debit on the left, credit on the right. A couple of students yesterday, or when was it? Perhaps Saturday's tutoring somewhere, were having trouble coming up with the balance of an account. Well, don't make that too hard, okay? The balance of the account. Cash, they started with 2,000 and then they spent 1,200. The balance was 800. Then they brought in 500 more, the balance is 13, etc. All you do is add the two columns and the high man wins. You add the two columns, subtract it out, and the difference would go on the side with the higher number. And they're demonstrating that here. When we say to debit an account, we just mean we're hitting the left side of the T account. Crediting means we're hitting the right side. And here we go. I don't know how to get this through you other than you just have to, hopefully you've done enough homework now and you've heard me talk enough where you're pretty clean. Assets have a normal debit balance. A debit balance. When we say a normal balance, we mean the side of the T account that increases. Assets increase with a debit. Therefore, liabilities and equity increase with a credit. You need to know that. Owner's capital, credit. Revenues go up with a credit. Expenses up with a debit. Drawing has a debit balance. And now they're giving you a couple of different looks at it. Take a peek here. Owner's equity. Owner's equity, the overall equity of the company has to have a credit balance. Revenues have a credit balance. Expenses have a debit balance. See the plus signs there? Maybe that'll help you a little bit. Here is the key right here. All you have to, I would suggest you look at the column on the right called normal balance. Assets have a normal debit balance. It means that every time you debit the cash account, it's getting bigger. You're adding cash. The expenses and drawing have debit balances. Expenses. You paid your employees $10,000 today. Well, that increased your expenses with a debit. Liabilities, owner's capital, revenues have credit balance. And I gave you that acronym, after eating dinner, let's read comics. For those of you who like that kind of thing, you can write it down. I think, Christine, you're the only one who seems to like that, huh? Okay. Let me know if I need to repeat that. After eating dinner, let's read comics. Assets, expenses, drawing on the debit side. Let's read comics, liabilities, revenue, and capital on the credit side. All right. Use T accounts. T accounts. Oh, we became experts in T accounts, right? T accounts. And they're taking us through these different transactions. Let me find one here. Here's a good one here. Mitchell made deliveries on account. So we know there's no cash in the entry. So he made a sale. We know sales go up with a credit. And we know it's not cash, so it would have to be accounts receivable. So take a look. Debit accounts receivable, credit delivery fees. Eventually, we'll get paid. We'll get a check in the mail in a couple of weeks, hopefully for $2,400, at which point we'll exchange that asset for the cash asset. Cash receipts. Remember your journal entries, you can have 3 lines in a journal entry, right? Here he made a down payment of $300 for a $1,000 scooter. Well, the equipment is a debit of $1,000 right here. He spent $300 in cash, so cash goes down with a credit, but he owes $700. And that's reflected in the credit to accounts payable, which increases accounts payable. So we go through the transactions. Just want to see anything that I think is worth The trial balance is not a formal financial statement. It's just a worksheet, huh? All it does is prove debits equal credits. It's in the order of your chart of accounts: assets, liabilities, equity, revenue, expenses. And here's the trial balance. Now, we worked with this trial balance for 3 chapters. I guess 4 chapters. No, just 3. Trial balance. And what they're doing here is they're color coding things for us, okay? They're color coding the assets, liabilities, capital, drawing, revenues, expenses. And keep in mind the Bob tip: everything after drawing, you draw a horizontal line under drawing, that is your income statement below, and everything above delivery fees is your balance sheet. And at this point, we did not worry about adjusting journal entries. We assumed that this thing was correct. And here we go. And we'll look at this one last time. Okay, we went to that trial balance and we picked out the revenues and the expenses, and we laid it out in a nice looking statement here. After we got the income, we're able to do the statement of equity. Statement of equity. We started off with 5,000, income of 5,250, but the guy took his salary out, I guess, $3,000. Gets us to a new equity number of 7,250. And then the balance sheet, all you're doing is copying every single number from the trial balance except the new equity number, because you're not going to see the owner's investment on the capital number. You're not going to see the drawing. You're just going to see one number, capital. That's all the world wants to see. So that kind of concludes here. I just want to see if there's anything else. I don't think so. Okay. So I think we went through all 6 chapters in reasonably good detail. Any questions, any comments, anything else that you'd like me to talk about?
This is just kind of like having a hard time with the modules. I haven't been able to find any of the recorded lectures except for the first one.
You know, I talked to Cornelia about that. Yes, yeah, go. Let me show you, okay? I find that hard to believe, but everyone's talking about that. Hold on. I mean, it takes me a lot of time to load these things, and I want you to make sure you can see them, okay? Let's go to the module. Let's pick out a module. You said you couldn't only for chapter 1, huh?
Yeah.
I've had the same issue.
Okay, I think you go to chapter 1 lecture. Well, let me share this with you, please. Hold on. Okay. You see it now, right, Shannon?
Yeah.
All right. This is the way I did it earlier. I thought Cornelia was just adding them right here. Like it would just say a line, chapter 3 video.
Yeah,
The way
just the first one.
it looked to me like you had to go to lecture, and there's Bob's noon lecture.
Oh, okay. Okay.
Hey, by the way, where's Nastasia? This is the first clip. Hi, Patty. God, let me turn this off. That's driving me crazy. How do you get rid of this? Oh, for heaven's sake. Oh, okay. That was kind of driving me crazy. So now you see how to get to the lectures, right?
Yeah. Okay.
Okay. Anybody want to make a motion to end the class? I do. I'll make that motion.
Sorry, one second.
And-
Just a note. Chapter 2 isn't
Trying
up.
to wake up a few people. And of course, I'm here tonight if you want to follow up with anything, okay?
I have one question.
Yeah.
So like, can we do the midterm like anytime now, or is it like, do we have to wait till tomorrow or?
Well, you can, if it's available now, you can do it. Yeah.
Okay.
Yeah.
Fairly
It's
standard.
just whenever Cornelia racks it up for you. So yeah. Just remember that once you go in, that's it. You just have the
That's
one
it.
shot at it.
Okay.
No. One student asked me if he could go into the test and then start it and then come back 3 days later and finish it. And I thought that was a kind of a bad security issue.
Yeah.
No, you just get one shot at it, okay? One bite at the apple and you're done.
That's it.
You understand that, Shannon?
Yes.
Shannon looks shifty to me. No, I'm only kidding. Okay, you guys take care, okay?
Thank you.
Alright.
Bye-bye.
Have a good one.